and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall, and here with me today is Ian Heslop, manager of the Old Mutual North American Fund. Hello, Ian.
Hello.
So I thought we'd start with Janet Yellen's comments recently saying that she thought that US equities were fully valued. When you've got the head of the Federal Reserve saying that, what should investors think?
Well, I think it's not an unreasonable thought that we've had a very strong run. The earnings growth that we're seeing around about 7% this year, with a valuation looking at kind of 18.5, maybe 17.5, forward 12. So yes, it isn't cheap. It's fully valued. But I think the question that maybe investors should be asking themselves is kind of where can I find value in markets like that? So there is always areas of the market where we can find interesting stocks, even if the aggregate market is somewhat fully valued.
So I suppose the next question is, where are you finding value then? Are you able to pick up anything at the moment?
Yeah, well, what we're seeing actually at the moment is, I think, plays into how we actually run money, which is a huge amount of style rotation, very, very unstable markets. I think it's interesting that when investors look at markets, they often look at things like cross-sectional volatility, so how stocks moving are relative to one another. And that's been very subdued, mainly due to the impact of the central bank and the liquidity from central banks coming into equity markets.
Do you mean that then that everything's come up together rather than there being a normal
Very
sort
much
of,
so.
yeah?
Yeah, but actually when you look within markets, there's a huge amount of style rotation, a huge amount of kind of winners becoming losers, becoming winners, value outperforming, then underperforming, then growth takes a turn. All of these things, when you're trying to build a portfolio for consistency, it plays into the idea that you really need to have a diversified style across your portfolio. So a number of types of stocks in the portfolio, and that's how we try to add value. So find good stocks, but good stocks in a number of ways to try and stabilise the overall returns.
I know that you used to prioritise value, but during 2008 that became, that threw up some value traps. So now it's just one of the considerations. How do you blend those different themes then?
Well, that's the kind of secret sauce, I guess. And what we're trying to do really is recognise that the market changes. Investors change, the market changes because of the way the investors react to information, because of the macro environment. The market changes, and you really need to change the tools you use to predict return. So we're very agnostic about what type of stock we need in a portfolio at any point in time. We often talk about this idea that we rent stocks, we don't buy them. We are not looking for very, very long-term positions. Our average position length is about 3 to 6 months. They come into the portfolio to do a job, and then they leave the portfolio when that job is done. And it is very much an idea of building alpha that's consistent over the long term. We don't want to be fund managers that only work when the markets are going up. There are a lot of them, or the markets are falling, or volatility is high or low. We want to be in a position where we can show very consistent returns. I think last year was a classic example of that, where many fund managers, I think a huge majority of my peers in North America underperformed the index. And I think they underperformed the index mainly because they have very concentrated style exposed portfolio. They are a value manager or a growth manager, or they have a lot of momentum in the portfolio, and that can lead to up and down returns. That's what we're trying to avoid.
I think it's very interesting there how short you hold stock for. Do you think that's because of the nature of the US market, which is obviously a developed market index? It's very transparent, there's a lot of information out there, because people perhaps investing in emerging markets looking for growth stories will hold a stock for 5 years.
Yes, that's true. I mean, a growth story normally is a growth story until the catalyst comes. And we would very much recognise that because of the way the markets work, because of the huge amounts of change that you see in the US market, and I think that is to do with the idea of efficient implementation of new information, which we have in markets. You just need a different approach. You need to recognise actually that you don't always have, if you've got the best mousetrap now, you don't necessarily have the best mousetrap for 12 months' time. And recognising that investors have a huge part to play in telling you which stocks that are likely to outperform or underperform. It's not just about us and what we think. We have to listen to everyone.
With all that in mind, where are you seeing opportunities at the moment then? What sectors look attractive?
Well, the interesting thing about sectors actually is the way that they've changed over the last 3 or 4 months. When we came out of 2014, the market was quite defensively placed in relation to sectors. So, for instance, you would have utilities outperforming, you would have energy underperforming towards the end of last year, healthcare outperforming, financials underperforming. We've kind of kept some of that, but we've actually moved a lot into the kind of more neutral stance, because we really do believe that the market at the moment can go one of two ways. And it is very difficult to actually take very concentrated bets in portfolios that could be very binary and could be very disadvantageous to the overall returns if you get them wrong. So for instance, the utilities position, which we've held for a while, is now more neutral in the portfolio. The same thing with energy. We had a very underweight position in energy stocks, which benefited the portfolio in the second half of last year. We've actually now moved that to much more neutral. And that's following really what investors are doing, what investors are telling us. The kind of interest in these sectors is changing. And that ties in with the change that we're seeing in markets in general, where there is a genuine rotation away from maybe the winners that have won over the previous period to new stocks, more interesting stocks, given the environment we're in.
And of course, those energy stocks you'll pick up on the cheap because they did so badly last year.
Well, yeah, I mean, energy stocks are flagging cheap, but again, as we always say, you know, sometimes cheap stocks are cheap because they're neglected by the market or they're misunderstood by the market, or sometimes cheap stocks are cheap because they should be, because they're a bit risky. So we have to make sure that we understand why things are cheap. Are they cheap because they're really a way of actually incorporating more risk into the portfolio, or are they there as an opportunity because they are actually just misunderstood by the market?
Ian, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.